Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Trevor, to our podcast show. I've been looking forward to this conversation for a while now.
Hi, Bilal.
Great. Now, before we go into the meat of our conversation, I do like to ask all of my guests something about their origin story. What did you study at university? Was it inevitable you would end up in finance, and some of the key milestones until now?
Yeah, okay. Well, I studied maths at Cambridge, so I came into finance very much from the mathematical side. I had no sort of family connections or tradition in finance whatsoever. And I guess I ended up getting involved in actuarial science as a career because I found out you got paid for passing maths exams, and I thought, well, that sounds all right. I'll do that for a while. I can pass maths exams. And I ended up working at the investment department of a mutual life insurer. And I was meant to be there just for 6 weeks in the summer of 1992, which is when sterling was kicked out of the exchange rate mechanism. And I kind of thought, well, this is amazing. This is fun. I'm involved in stuff which, you read about in the newspapers. And I got the investment bug from there on, really.
Great. No, that sounds really good. And in terms of actuarial sort of training almost, I mean, do you find that helpful, this kind of probabilistic way of thinking?
Absolutely, yeah. It is really helpful, both in terms of investment thinking and also in terms of product design, if you like, thinking about investment funds for particular outcomes and purposes, especially when it comes to things like retirement and decumulation and all these sorts of issues. But generally, yeah, having that sort of way of thinking about multiple possible outcomes with probabilities attached, I think is really critical as an investor. It's very easy to become very black and white. You've got your base case, you stick to it come hell or high water, and that can be really damaging because you end up hanging on to it for far too long. And you've always got to have this idea there are various possible outcomes and what's shifting of the probabilities. And you won't get all your calls right. If you get 55% of them right or 60% right, and you're controlling risk properly, that's your job.
Yeah, I kind of almost think why actuarial science isn't more it isn't more of a training ground for finance people. It seems to be kind of often certain sidetrack into the insurance
Yeah,
area, but you almost think that's almost it's almost like a better training ground than say an MBA or something like that, or accounting even.
I think it probably is. There are quite a few actuaries in fixed income markets for one reason or
Hmm.
another. I guess historically, um, to get a job in an equities team, you had to be pretty blue-blooded and know the right people, and that's not true anymore. But certainly, when I started out, there was a definite class differential between the equity managers and the bond guys who knew the maths, and they came from all sorts of backgrounds. So I guess these things are quite slow moving, aren't they? So a lot of senior bond people will be actuaries, but stock
Yeah.
pickers not so much.
Yeah, no, I'd agree on the class differences as well, because I come from a fixed income FX type background, and you definitely notice the differences with the equity
Mm.
brethren. Now, in terms of your investing approach, I mean, do you have a framework of sorts for investing?
Oh, absolutely. So every single, well, first of all, I'm a multi-asset investor. So we have a strategic asset allocation framework, which is active as well. A lot of people think of strategic asset allocation as trying to achieve a particular risk return outcome, and they think of it as fire and forget. 60 stocks, 40 bonds. For us, it's a living thing. We're reviewing all the time what we think the outlook is for each individual asset class. We're reviewing what sorts of scenarios and stresses we need to make sure we're resilient to. So there's a whole process around strategic asset allocation. And then the tactical day-to-day asset allocation has a different process. And this process is, again, quite mathematical. Maybe not surprising with the actuarial background, but we like to think of factors that can help you make a good decision. And each of the strategies that we operate, things like cross-asset strategy or regional equity strategy or currencies, whatever it is, we have multiple factors, each independently back-tested. They all add some kind of value, but at different times. We create a multi-factor model. And then if you like, the overall tactical asset allocation is a multi-factor model blended with other multi-factor models, and you end up with this quite diversifying set of different trades, which will be influenced by macroeconomic or fundamental factors, valuation factors, technical factors, and they then feed into a human meeting. And on a daily basis, trades are being suggested, and they'll make sense to us because we've all grown up through the process. There are about 14 of us on the team, and we all know how the models work. And so when the economy starts to recover and the models want to buy equities, we aren't surprised by that. And in a way, it does a lot of the work for you. It's like a screening process, and you can then focus a little bit on what might be different this time. And we try not to override the models too much because, the models are designed to avoid behavioral traps. And as soon as you start saying, "Oh, it's different this time," you're reintroducing, if you're not careful, behavioral traps. But they are meant to be sort of something which aren't necessarily plugged straight into the trading desks. You're meant to still be thinking independently. The models might want to do something, and you might decide actually with a Fed meeting tomorrow, we'll do it on Thursday. And so that human interaction is still important.
And you mentioned factors. I mean, do you mean factors in the academic sense of term like risk premia and carry and momentum, those sorts of factors, and you have your own range of factors in addition to the conventional ones?
Yes. So, for example, for a cross-asset strategy, and by cross-asset I mean global equities versus global government bonds, cash, commodities. Um, we'd be looking at a business cycle model, something we call the investment clock. We'd be looking at relative momentum of different investments. We'd be looking at some seasonality factors, um, in some cases valuation factors, and all of these feed into a kind of composite model, if you like, that is recommending what to do, and we can simulate the added value from this composite model back to the mid 1990s. So we're trying to look at a big sweep of history, different macro environments. I kind of find it funny sometimes when someone says, "Oh, we've back tested our model and we back tested it back 3 years," and you go, "Well, that's not much data, is it?" And they go, "Well, yeah, but we use minute by minute ticks." So we've got, 50,000 data points. I'm going, "Yeah, but it's still only 3 years, isn't it?" So we like to look back through decades and not do something that only works in one regime.
Yeah. Now the approach you take is mathematical, as you said, systematic. I mean, why did you pick that approach rather than a more discretionary approach? Because many multi-asset fund managers, in the UK, US, Boston, and so on, I mean, they have a purely discretionary approach, but obviously you've taken a very different systematic or
Mm.
mathematical approach, you could say. Why do that?
Well, when I first came into, well, I started off my career in asset management, went to the sell side at an investment bank for 10 years. Then I came back into asset management, and I came back into an existing investment process. And this investment process consisted of people flying to Bermuda 4 times a year. And there was a discussion around a table, and then they voted. And there was all sorts of misbehavior. There were some people who always agreed with the chair. There were some people who always had yesterday's Financial Times on the table and were pointing to what happened yesterday. Some people always said things like it's never too late to underweight Japan because of a scarring experience. Some were valuation believers. You could never buy equities because they were above a certain threshold in their head. They were too expensive. And then you had tactical voting. You had people saying, "Well, I want to underweight Japan." And you would say, "Well, what's your bearish case?" They would say, "I'm not bearish, but I want to be neutral. I know that she's overweight." And it was just a nightmare. And then you were only trading 4 times a year because it was a quarterly process. So you've got all those behavioral things floating around. And you do 4 trades a year on dates you didn't choose. And then sometimes the senior management would go, "This tactical asset allocation process doesn't do much, does it?" And I just thought we've got to get away from that. So in that job, I, as director of asset allocation coming in, needed to create a model-based framework to kind of herd the cats. Okay, valuation matters. It's a factor. Your factor's already in. Momentum matters. If it's a factor, it's already in. And the idea was to have a central point for discussion that didn't suffer from recency bias or anchoring or risk aversion. It was a logical central position. And over time, I've gone from that sort of model-based framework being like 30% of the investment decision, with lots of discretionary stuff floating around, lots of personalities, to a situation where now I'd say it's at least 80%. I don't want to get to 95% because then you end up falling in love with your quant models and there's some kind of quant crash. You having that little bit of discretion is important because it also keeps you fresh and it helps you improve the models. Because if there's something where you're always overriding the models, sometimes there's a reason for that. And it might be there's another factor that you should be bearing in mind. A good example would be we didn't used to have investor sentiment as a factor. And you can imagine a multi-asset model. If the business cycle's turning down, it sells equities. If price momentum turns negative, it sells equities. and you go really, really short, and then the Fed cuts rates and the markets rocket, and you get your head handed to you. And we'd find ourselves overriding. We'd say, yeah, we know the model needs to be really short, but everyone's so depressed. I don't want to be short. And what we ended up doing was creating a separate sentiment model that would actually cover your short for you. Um, and it's very hard to cover shorts in that environment if it's not in your model. If it's in your model, it's very hard to disagree with your model. And buying a dip is scary. But if your model says buy the dip, if you like your sort of slow brain, Daniel Kahneman thinking, has done all the work, it's telling your fast brain buy the dip, you're much more likely to do it. But if it's kind of an override and it's discretionary, you'll do it at the wrong time, or you'll kind of just not do it, you'll bottle out.
And on the sentiment measure, I mean, without giving away the secrets, I mean, how do you go about
Mm.
constructing something like that?
Well, there are many different people's versions out there. We did something very simple. We looked at about 10 different individual indicators that different people had said over the years worked. And again, it's the same sort of framework I mentioned earlier. We tested them all individually, and we came up with 4 that we thought actually did work. And then we created a composite of those 4, which again is a way of sort of improving information ratio. And so things like put call ratios people talked about a lot. And when we tried to actually process them, it was a lot of noise and put call ratios, because sometimes you've got a big hedging program going on. It's not really about people being bearish when they're buying puts.
Hmm.
So it tends to be simpler things like, VIX volatility, private investor sentiment, whether company directors are buying or selling shares in their own companies, these sorts of things which we've included.
And in terms of adding new inputs, you described one way where there's a persistent override that comes
Yeah.
about. Are there other ways you add a new input? I mean, are you trawling through academic literature? I mean, how do you decide on a new input? And then equally, how do you drop a factor on the other side?
Yeah, it's a really good question. I mean, we have a very vibrant team of people, including, a couple of guys who came through the intern program here a few years ago. And so there's a research program, if you like, of people coming up with suggestions and ideas. We really like to stick to things which are economically defensible. There's got to be an economic logic to them. And that economic logic, I could say economic logic, it could be a kind of, investor sentiment. At some point, you flushed out all the sellers and no one left to sell. And that's why there can be a signal to buy. It's not an economic logic, but you can see the logic there. So we don't want people data mining, who won the Super Bowl, that kind of thing. There's got to be a story and a logic to it. And then we're interested in trying to find out how best to represent that factor mathematically and what works and how you process it. So there's quite a bit of work around that. Sometimes we come up with new factors because we want to do new things. So at the moment, we're working on a gold model. The reason I want to work on a gold model right now is I think we could be entering into a recession with a weak dollar and falling real interest rates. And you want to be defensive, you want to own gold. So if you like, there's a kind of a hunch, a discretionary view that gold could start to get really interesting. And I don't want to just buy it on the basis of a story. I want to have models and factors that will help me decide at what level to buy it and what level to reduce positions and sell it. And so some of it's actually coming from sort of, if you like, experience, saying this could be something really quite good given what we think we're going into. Some of it is just a desire to kind of add breadth to the process we've already got.
And in terms of the sort of mathematical approach, I mean, is it like an econometric approach, or are you using some machine learning now as well, given the rise of AI and big data and so on?
It's not either of those. It's simpler than that. I mean, it used to live in Excel spreadsheets, so it's MATLAB coding these days. But it's more kind of if you imagine you're trying to test a strategy where your maximum conviction long is a +10 and your maximum conviction short's a -10, and you might sort of look, for example, at momentum. So you might sort of say, okay, I'm going to look at regional equity markets, and I'll add to a market if it's beating other markets on the momentum ranking. And we'll look at different look back periods, and we'll attach a position size, and then we'll simulate that and see what the added value looked like and what the information ratio looked like and the consistency of it. And that's the approach we would take. So it's not really econometric, and it's sort of a human machine learning, really. You could kind of get the machine learning to do it, but I'm always a bit suspicious of trying to over finesse. Because it's a funny thing, actually. Even you can do this work yourself very easily. If you sort of say I'm going to use a particular momentum indicator, I don't know if a stock market rises above its 3-month moving average, I buy it, and if it goes below, I sell it. and then you say, using monthly data to do this. If you actually work out the added value and the information ratio, and you think you really understand it, and then you say, rather than trading on the first day of the month and looking at the data on the first, let's look at the second trading day, and the third and the fourth and the fifth. You'll find actually quite different outcomes. And the machine learning will say, well, it's got to be the first Wednesday because that was the best number. But you just know that's just nonsense. And
Yeah.
so I think in a sense, you need to have that sort of human filter in there that says, you know, do not overanalyze this because you'll come up with something you believe in too much.
That's a good point. And to some extent, you almost become a slave to the technique or the models, and it gives you this false sense of security.
Yeah, and that's important. And it's a bit of a challenge because the models have become, in some cases, relatively sophisticated. They might have 3 or 4 or sometimes even 5 different factors, and each factor might look at different look-back periods. And what we really want is that the portfolio manager team has to be so close to the models that they know what the models are doing, and so that, there's not a big debate about why did the model add or why did the model
Okay.
sell. If you make it too complicated and if you make it too distant from the people actually pulling the trigger, it becomes the quant department. And I've worked at places where there've been quant departments producing numbers +7, +6, sell this, buy that. And the danger is you then go to portfolio managers, you go, forget that. I've just picked up the FT and guess what's happening? I'm doing this. And suddenly you've got no pass through to the actual portfolio. So you don't want to make it too complicated because then it doesn't feel natural. It's meant to be a screening process that does the sort of things you naturally would want to do as a good investor, rather than something that becomes impenetrable.
And an event like COVID, obviously the post-COVID regime has been quite different to the period before. So it's almost like we had the post-GFC period, which is very
Yeah.
different to the period before that. And suddenly that interrupted with COVID. And since then, we've had this new regime. So what in your process or your way of thinking, what's changed in the last 2-3 years now that we've had this COVID shock, inflation's back? Things just feel very different now. I mean, what has something have you changed something in your framework or approach?
We did change something, and it was partly out of practicality. So, we used to have I mentioned my previous employer, we had this quarterly investment process. I turned that into a monthly investment process. When I moved here 7 years ago, we made it a weekly investment process. So every Monday, we'd update the models and we would trade. Post-COVID, it's been a daily investment process. And partly that was because we needed a daily team meeting. Things were moving so fast. We needed to review what was happening on a daily basis. We needed to be together through Zoom on a daily basis. And when you've got a daily meeting, the indicators you need to use are different from the indicators you would use on a weekly meeting or a monthly meeting. And so the whole process has to adapt to this higher frequency of looking at stuff. It doesn't mean to say you're trading a lot more in terms of turnover, but the risk control is daily. You want to avoid things that will flip around too much from one day to the next for no good reason. And so post-COVID, we've had a much more daily management and risk control process, which we've stuck with and we really believe in now. And that's one thing that's changed. The investment environment has changed, but I think primarily what's happened is the inflation environment has changed hugely. And because we've looked back over models that we want to work since the mid-90s, the models aren't wrong-footed too much by the fact inflation's now more of an issue because the models have already been designed to imagine that inflation could become an issue. If you've got 1994 in your back test, you know about inflation. If you've got the late 80s in your back test, some of our models go back that far, you know about inflation. And our investment clock model in particular, our macro model, that imagines a sort of a growth cycle and an inflation cycle, which are independent of each other. And this is the maths coming back now. So I've got a sine wave and a cosine wave. You've got these two different waves which are out of sync with each other. And if you plot one as the x-axis, the other as the y-axis, in theory, you draw a circle. And that's the investment clock. And the investment clock allows you to sort of think about growth indicators as a vertical position, and then inflation indicators left to right. And depending on where you are in those 4 different quadrants of that growth and inflation mix, it will point to different things. So the investment clock was already sitting there ready to know in stagflation, like 2022, in stagflation, you wanted to be long commodities, short bonds, and short stocks. So no surprise there. So in a way, our models were ready for the new environment, but they started doing quite exciting things that they hadn't had to do before.
And you touched earlier on that you're interested in gold partly because you think there's a
Mm.
recession risk, and you mentioned the circle. I mean, where are we now on the
Yeah.
clock?
Not where I thought we'd be. This is the other great thing about having models, because you have a narrative. You're bound to have a narrative.
Yeah.
And then stuff happens that you weren't expecting. And obviously the COVID shock was one of those things that happened out of the blue. But we've, if we'd had this conversation 6 months ago, I would say by now we'd be in quite a bad recession. And of course we're not. It may yet be happening, or maybe it's waiting for Godot and it never happens. But even though I've remained worried, if you like, about the macro outlook because of central bank tightening and the inflation shock we've had, we've been long equities since September last year. Now, initially, we were long equities on sentiment grounds because there was a serious panic in September. And I think a lot of that was actually driven by the Truss debacle. Because I think, although the UK is not the world's largest economy, it's got a big pension fund industry that was just dumping everything. And so you had this big global risk off. And we thought this is not a sustainable policy mix. We thought it wasn't a sustainable government. And sentiment said to buy anyway. So we went overweight equities for the first time last year in September. And it could have just been a trade that lasted a few weeks. But then our momentum indicators started improving because the markets kept recovering. So we stayed long. And then at the turn of the year, the macro indicators that drive the investment clock started improving. It's not a boom by any stretch, but it's what was a very negative macro outlook in Q4 has got less negative because energy prices have dropped, China's reopened, US mortgage rates have stopped rising. There are a few things like that which have actually helped deliver this bit of a removal of negativity rather than a boom. Meanwhile, our inflation lead indicators, and we have inflation lead indicators which you pay just as much attention to as growth lead indicators, they've flipped from pointing very strongly upwards to pointing very strongly downwards. So supply chain indicators, prices paid, commodity prices, the sorts of things that you put into an inflation lead indicator are pointing down. So we've got a growth recovery with falling inflation. That's the diametric opposite of stagflation.
Yeah.
So you've gone from, stagflation to a disinflationary upturn, which is good for stocks, good for growth stocks, good for technology. And then when we stayed long, and we're still worried, and we're still long.
Worried and
But at
long.
some point, we're worried and we're long, and I think we're not alone. I think a lot of people are worried and
Yeah.
long. I do think at some point the markets will crack and the economies will crack. But our simulation over multiple decades has told us you can't go short early. The momentum will start to go the wrong way. You may miss the turn. Maybe actually the start of it happens so fast that actually you end up buying because there's too much panic in the initial sell-off, and you sell later. Maybe that's what happens. And that's what happened with us in going back in GFC. Because in GFC we were maximum long equities in July of 2007. That was the very peak, um, and we ended up sticking with it in the first sell-off because sentiment was already so panicked. And you may not remember, but at the end of 2007, the markets bounced back, and actually the
Yeah.
FTSE and the Hang Seng and other markets made a new high because suddenly the equity markets were going, well, I've got over the panic, and now look, the Fed's cutting rates. Isn't that great news? Um, and that's when we went underweight. So you don't necessarily have to be underweight at the top. Calling the top's hard, and you might get another opportunity, another bounce to move underweight if what you're heading into is a long bear market, which it could be.
And I guess in some way, what you've just described in those two instances, this year's position that you've had in equities and also that pre-GFC position, is examples of where, from a behavioral, your bias perspective, you're worried, or you're seeing subprime news back in 07 or today. We have the scars of 2022, but your model and your framework tells you something else. And so this really shows you the power of it in some ways, that you just trust the models, the framework, and
Yeah.
that kind of allows you to overcome some of these biases that one has.
I think it does, and it comes back to your question early on about this sort of actuarial approach, where it's a probabilistic approach. You might have a base case, but it's not 100% probability. And as your alternative case starts to gain traction, its probability is going up. You should be reallocating towards it, and that's what the models help you do. Sometimes the models take you to places you weren't expecting. So even though we didn't forecast this disinflationary recovery, we've been well positioned for it. And I actually think that investing is more about nowcasting than forecasting. It's not about guessing what happens next year and positioning for it now. It's about recognizing the signs. when a regime is changing and gradually repositioning at those turning points.
Yeah, that's a really good point. And one other kind of big focus over the last year or so has been bonds versus equities, or whether bonds still act as a diversifier within a portfolio. Obviously, everything went down last year. Now there's big discussions around what is the diversifier if you have a risk
Yep.
portfolio. Do you have thoughts on that?
Well, I do, and I think that 2022 was a real wake-up call. So I'm missing a scatter plot that one of the large passive houses put out in the US towards the end of last year, and it shows the performance of the S&P 500 versus the performance of the 10-year Treasury. And last year, as you know, you lost 20% on both. This scatter plot makes that look like an act of God. You know, it's an outlier. It's so far away from everywhere else. There were only 4 years in the last 100 which were in that quadrant where you lost money on stocks and bonds and absolute returns in the same year. And I think what that misses is that what causes stocks and bonds both to do badly is an inflation shock. And if inflation shocks are what cause stock and bonds both to do badly, I know, let's look at the scatter plot in real terms. Let's adjust for that inflation rather than nominal terms. And if you do that and you look at real stock returns versus real bond returns, that bottom left-hand corner suddenly gets very busy. It's got loads of years in there, 73, 74, 79, 89, 94, loads and loads of years which are inflation shocks. In real terms, bonds lose you money and stocks lose you money. And what 2022 tells me is that if we're in an environment where we could see more inflation shocks, then balance funds are not diversified enough because the stocks and bonds will both lose you money. And I do think we are in this new regime that we were on the panel together a while back that I'm calling Spikeflation, because I think there are all sorts of structural reasons why we'll see more frequent spikes in inflation than we've seen historically. And that does mean more years when you need to have diversification into things like commodities and more need to be a business cycle investor, because if you get inflation spikes, you get short rates going up and you get recessions more often. And I think we're going back to a 5-year business cycle from what had been a 10 or 15-year business cycle.
No, that's really good. I mean, I like your point about looking at things in real terms rather than nominal terms, because I think that's one thing that we've become quite lazy about because we've been in a very low inflation environment.
Yeah.
The other thing I think we're being lazy around is looking at absolute returns rather than excess returns. Now that the cash rate is up to 4 or 5%, people still are reporting the absolute return rather than the return above cash, which actually gives you a different set of results.
And I think monetary policy works in two ways. It works through raising the cost of finance, and when you've got people on fixed rate mortgages or they've termed out their high yield bond issuance, it can be quite slow to get through. But it can also work through financial markets, and particularly with this world at the moment where you've got so many non-bank financials extending credit, private lending and all this kind of thing. What happens is that as those cash rates rise, institutional investors start asking themselves the same question. We've come across people that are in a multi-asset fund who've said, if you think we're going to return 5% per annum over the next 5 years, which is our capital market assumption, why don't we just buy the 2-year gilt? And you're less kind of going, well, I can think of lots of reasons in terms of reinvestment risk and all of those scenarios you might be missing out on because, it's only one asset and you're not diversified. But you can imagine there's a loud sort of sucking noise at the moment where risk capital is starting to go into risk-free capital. And at some point, and it's very non-linear, you get the crack in credit spreads and credit markets generally, which is a big sudden discontinuity in the transmission of monetary policy. And I think that could be out there somewhere. So I'm quite nervous about, our models at the moment would be much longer high yield debt than I want to be. So that's one place I'm overriding. I've got a more modest position in high yield debt because I think that when that crack comes, those markets could become much less liquid.
Yeah. And you mentioned this spikeflation idea and shorter business cycles. What are some of the factors you think are leading to this?
Well, if you like, the smoking gun at the moment is COVID. So what we saw with COVID, and I really, really buy into the sort of Larry Summers description of COVID, the lockdown is like a very long weekend where activity collapsed, and on Monday morning it came back to life again. The problem was that when activity came back to life again, the stimulus was still there. So you had all that monetary and fiscal stimulus, wartime levels, in a supply-constrained economy. It's not surprising we've seen a lot of inflation. On top of that, we had the Russia-Ukraine, which I think added a bit to it, but it was already a big problem. Going forwards, I mean, we might not see that same sort of particular driver, but I think the transition to net zero is important because fossil fuel industries are being underinvested, and it's logical that they're being underinvested because people are weaning themselves off fossil fuels. But that does mean when you get an economic recovery, you quickly hit bottlenecks and commodity prices will spike upwards. You've got deglobalization in terms of the deterioration of relations with China, onshoring post-COVID, Brexit, all these sorts of things. You've got a lot of high levels of government debt, which give an incentive to allow inflation to get out of control. I'm always a bit skeptical about inflation targets. You know, the Bank of England, for example, has a 2% inflation target, which it overshot by 4 times the target over the last year or so, and it's not intending to undershoot by 8 in future years. And a lot of central banks have this "let bygones be bygones" attitude, which means that, you know, governments get to inflate away some of their debt. Populism, geopolitics, it feels more like the 70s. So I think we could find ourselves every business cycle has a commodity shock, a spike. So every 4 or 5 years, you get to the point where inflation's out of control again, and that creates these more frequent recessions.
And no, that all makes sense. Now, just coming back to the industry, asset management as a whole, there has been this big rise in passive management just over the last 10, 20, 30 years. ETFs, low fees by all these different index providers, and returns, based on some kind of 60-40 or some variation of 60-40 being fantastic. Obviously, last year didn't work. That could just be a one-off. But what's your view on passive multi-asset, say?
Well, slightly controversial, but maybe you wouldn't be surprised to hear me say this because I'm an active multi-asset manager, but I think there's no such thing as passive in multi-asset.
Okay.
I mean, there's passive equity, pick an S&P 500 index, you can manage that passively. But as soon as you're in multi-asset, you've got to decide the weightings of the different asset classes. And as soon as you've got more than 2 asset classes, there's not a single solution that works. We all know if you try and do this is back to strategic asset allocation, but if you try and optimize a portfolio for a particular level of volatility, you'll get really strange corner solutions. So if you put the asset classes we've got into the optimizer, it will say, I've got your perfect efficient portfolio. It's 50% commercial property and 50% high yield debt. And you kind of go, not sure about the resilience of that or the liquidity of that. And so you've got more different considerations to make in the first place. So I think you have to think about what bonds are priced for. I mean, 2022 was horrific for passive multi-asset because a 60-40 fund had 40% in long duration bonds. Our equivalent portfolio had 15% because we knew bonds were priced for perfection. They were return-free risk. So we had a very low exposure to bonds. So that's irrespective of the whole business cycle side of things as well. And if you want inflation hedges in your portfolio, like commodities, equity, commercial property you can't manage passively. So I think actually we're in an environment where, the 60-40 funds with fixed weightings worked really well for 30 or 40 years, low stable inflation. Now I think they're going to be much more challenged.
And more generally in the industry as a whole, do you think that there's other changes underway? Like, for example, younger investors like to trade themselves. They may have other objectives, environmental objectives, things like that. Are there some other trends you're observing?
Certainly, there's a big trend towards sort of ESG integration in one form or another. That's more of the challenge than you might think with multi-asset, because multi-asset, you tend to have different approaches in different asset classes. And the regulators haven't really latched onto this. So a lot of the regulators will say, well, your label will allow you to say you're a particular thing if you're doing the same kind of ESG in every single asset class. Whereas, for example, with us, our emerging market equity tracker is hard screened ESG. So it has exclusions on ESG grounds. Our other equity market trackers have carbon tilts. They're reducing carbon. Our active equity funds use integration. We have some sustainable bond funds.
Okay.
We have exclusions on munitions and oil in our cash funds. And it's like Frankenstein's monster. So I think, there is a bit of a challenge in the industry understanding all of this. But I think what people have got to get to with that is that you've got to still stick to your investment principles while integrating ESG. I think the first gen ESG funds were basically screening out energy and screening in tech, and the sort of tracking error they were taking in doing that was enormous. And of course, for many, many years, they performed really, really strongly. But I think actually you need to control the investment risks while also integrating ESG as you look at it below that. I think that's the biggest current change. AI could be interesting, something we're certainly open-minded about where it fits in. But I think the danger with AI is the same danger earlier on I referred to in terms of over complexity in your quantitative models, that you end up with a monster that nobody really understands, and maybe you back it, and then it suddenly goes horribly wrong. So I'd like to sort of control the complexity, and that probably means we're less likely to want to go too far down the AI route.
Yeah, yeah, yeah. No, I'm sympathetic to that view. Now, I did want to ask a few more personal questions. One
Yeah.
was, what's the best investment advice you've ever received from anyone?
I'm gonna quote this as Anthony Bolton. So I worked at Fidelity for about 10 years, and Anthony was the sort of eminence grise of stock picking in the UK, fantastic investor. And when I was in real difficulties with understanding what was going on, I'd go and see Anthony. So he was a great sort of mentor at times. So in GFC, for example, we'd sort of we bought equities. We were short equities towards the end of the sell-off, and the markets rallied hard, and we were trying to figure out what was going on. So I went to go and see him to talk about some of the issues there. But the best thing he ever said to me, actually, in some of his books, is that don't wait for full conviction before you get your full position size. So what he would say was, if there was a stock he knew nothing about, but had heard a couple of things about, and it sort of piqued his interest, he would actually start buying it. He'd done no research at that stage. He'd make a small holding, and then when he next looked at his portfolio, he'd see this small holding and think, "Oh, I better look at that one a bit more." And he'd do a bit of research, and he'd build up this position, but it started off very early. And as he gained conviction, he increased the position size. And then sometimes if there was a bit of news he heard which didn't really fit the thesis, like the first spot of rain on the cheek, he would sell a bit. He wouldn't have time to do a lot of research, but he'd start selling then. And that's something I've always believed in, that sort of starting positions early when it's not your base case, but it's becoming less unlikely, and then beginning to trim your base case early again, not sticking too late. Because if you're a very thematic investor, you have a very strongly believed base case, and you stick to hell and high water until the market smacks you in the face, and then you decide to come up with a new base case, and that doesn't work.
No, this is fantastic advice. I mean, you could apply it to investing. You could apply it outside. I mean, I'm just thinking from a business perspective. We have Macro Hive, a small business, startup type company, and what we do is release products on a beta basis. So it's not perfect, just release it to see how it performs in the wild. And I think that's the overall philosophy of perfection. Not, nothing will be perfect. Or in the market context, if you have 100% conviction, presumably at that point the price is adjusted anyway. Because no matter what we think, we're probably similar to the crowd as well.
Yeah, people who say if it's in the papers, it's in the price.
Yeah. Another question was, what advice would you give to younger people as they leave university?
Well, the main thing is do what you're interested in, do what you love, and you become good at doing what you love, and you naturally love what you're good at. So listen to your heart in a way, and pursue the things that you're curious about and you want to develop, and you will always be learning. Make sure you surround yourself with people that you're learning from. It's just quite a high bar this at times, but I always like to think that I always want to work for people I like, respect, and admire. And 2 out of 3 is okay. 1 out of 3 is already not okay. And you've got to like the people you work with because you spend a lot of your life with them. There's got to be mutual respect, and you've got to admire them and feel that you're learning from them. And that's very important. It's all about that sort of learning curve when you're starting out. And the other thing, which I remember literally the first time I joined the investment bank, there was a guy retiring, and I asked him the same question: "What's your advice to someone starting out in this kind of career?" And he said, "Always be nice to everyone." And he said, "It seems like it's the right thing to do anyway, morally,
Of course,
but it's also the self-interested thing to do because it's a really small world, and if you're unpleasant and difficult to work with, people will remember that, and in 5 years' time, actually, the person you fired will end up being your boss." and it's the right thing to do anyway. But that's a good bit of advice. Always be nice to everyone. Don't, if you
Yeah.
cut corners and you're a sharp customer, you probably won't actually do as well as
Yeah,
you
no, I
might
totally
want
agree
to.
with that. The people you meet on the way up, you're going to meet them on the way down. So
Absolutely, absolutely.
And I do also like to ask questions of productivity. I mean, for you, I mean, you have to cover so many markets. You have the models,
Yeah,
speak to
yeah.
investors. There's a lot on your plate. I mean, how do you ensure you're productive?
It's tricky. You are multitasking in a big way, and um, for me, I think it's human contact is really important. So you haven't got time to read all the things you need to read. Um, so I think you need to kind of surround yourself with people, make contacts with people who can synthesize what they're seeing and what they're reading and feed through to you. And that's what I do. So um, having been someone writing investment bank research, I'm now on the receiving end of reams and reams of investment bank research. And when someone says, "Well, didn't you see my report yesterday?" It's like, I mean, you're lucky I've had time to open an email. And so what I'd like to do is be in contact with people who've really got good judgment and can summarize things for you. So make use of your human network.
Yeah, absolutely. And I very much agree with that. And then in terms of books, are there any books that really influenced you?
Well, I'm going to mention two, and they're kind of related in a way. So one of them is Kahneman's Thinking Fast and Slow. And this is I have to immediately put my hand up. I've not read it cover to cover. I've dipped in and out of it, but I love the concept, and I built my investment process around the concept of a slow brain that's methodical, careful, analytical, but can't come off the fence, and your fast brain that makes decisions. And what you need to do is you need to put the right information in front of your fast brain, because your fast brain will make the trade. And if it's
Mhm.
surrounded by the wrong information, like the wrong people or a screen full of red, and you're panicking and you're selling because everyone else is selling, you'll make bad decisions. So use your quiet, calm brain to develop your investment process, back test it, show it works, show the hit rate. And then your fast brain will say, well, I feel like selling because everyone else is selling, but 9 times out of 10, when this indicator flashes, my slow brain told me I should buy. And that really helps. So thinking fast and slow is really, really important, I think. And a spin-off from that, there was a book a few years back called Happiness by Design by a guy called Paul Dolan, who was one of the students of Kahneman. And that's more a kind of self-help book. But it's the same kind of idea. It's kind of actually sort of thinking about using your analytical, slower brain to figure out what kind of career you want to have, what you want to be doing with your life. Because in the cut and thrust of daily stuff, time just rolls by. You've got to take that time out and actually think of how can I design my life to mean I'm spending the maximum amount of time doing the things I love rather than just paying the bills. And I've known people that have retired, and I've said to them, why don't you stick around and do consultancy or hang around a few more years? And they'd say, "You kidding? I've been waiting 30 years to retire. I've always hated my job."
Hmm.
And I think you can't be like that. It's not good for you.
Yeah, no, that's a great piece of advice. Great recommendations there. Now, finally, what's the best way for people to follow your thinking, your work, and
Mm.
follow what you're doing at Royal London?
Well, we're active on LinkedIn, so Trevor Greetham at LinkedIn. We also have our sort of website, investmentclock.co.uk, where we publish our research, and you can get in touch with us that way.
Great. I'll make sure to include the links on the show notes. And so with that, thank you very much for that really colorful and enlightening conversation. I
My
learned a
pleasure. It's
lot,
been a lot of fun.
and good luck with everything for this year.
Fantastic. Likewise. See you soon.
Great. Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.